Hey, this is David and welcome to the Tuesday topic. How much does your credit score really cost you? When we're talking about a mortgage loan, it's a ton of money. Now, typically you can obtain a mortgage loan when you have a 640 credit score. But from a 640, every 20-point increase to your score is going to reduce the interest that they give you when you take out that loan, about 0.25%. Now, that might not seem like a lot of money, but on a $250,000 loan over 30 years, it really adds up. The difference between a 640 and a 740 on that $250,000 loan is an extra $182 that you're going to throw away each month in interest. Over 30 years, that's over $65,000 that your 640 credit score just cost you. Now factor in your credit cards and your auto loans and your bank loans, who really blast you with higher interest rates. That could easily add another $100,000 over that 30-year time frame. So now you're at $165,000 that you've thrown away because you had a 640 credit score and not a 740. Now imagine you had $165,000 to invest in that 30-year time frame. That could earn you over $300,000. Add that to the $165,000, and now your 640 credit score just cost you $500,000. Doesn't it make sense to get your credit score as high as possible? Hey, we have an expert team of advisors that would love to point you in the right direction and answer any questions. As always, like and share the video. If you have any questions or comments, leave them below. Thanks again for watching, and we'll see you next week.